Andrew Williams.
Take a call on the Reserve Bank of New Zealand Covered Bonds Amendment Bill on behalf of New Zealand First. New Zealand First will be supporting this bill and this legislation. Covered bonds go back to the 1700s, Mr Chairman. Denmark was the first country back in the 1700s to issue covered bonds. So they are a very old form of financial security and an old financial tool. More recently, of course, they have been a major tool used by European banking, but in more recent times, the likes of the United States Department of Treasury introduced them in 2008, and the Australian Treasury introduced them in 2010-11. New Zealand banks were the first in this part of the world to actually start using covered bonds. That was back in 2010, but they did not have the legislative framework to work within, which is the purpose of this bill, to actually give them that legislative framework to cover those bonds. Covered bonds are debt securities that are backed by cash flows from mortgages or public sector loans. A covered bond is a corporate bond with one important enhancement. It has recourse to a pool of assets that secures or covers the bond if the originating financial institution becomes insolvent. In this day and age, in the world that we live in, it is increasingly important that we do have these guarantees put in place to ensure a stable and reliable banking system. In this respect, the Reserve Bank of New Zealand Covered Bonds Amendment Bill does help to bring New Zealand into line with many of our major trading partners, in particular Australia, the United States, and many of our trading partners in Europe and Asia. Mr Speaker, we also did have some reservations as to why New Zealand was adopting the 10% maximum number of covered bonds as compared to Australia on 8%. In this House and in Parliament and throughout legislation, we are regularly referring to the fact that we need to harmonise as much as possible with our major trading partner Australia and where so much of our banking and financial interests are trans-Tasman. Therefore, it is somewhat puzzling as to why we would not simply adopt the same 8% level as Australia and that we would have a higher level, and that still has not been adequately explained. And countries, as we've heard, such as Canada, as low as 4%, does beg the question as to why New Zealand would go to a much higher level. Because at the end of the day, should a bank fail, it means that these covered bonds have preferential call over other investors in the bank, other depositors in the bank, and therefore we wouldn't necessarily want to see that the first 10% of any failure in New Zealand going offshore to international investors first, perhaps before mums and dad investors in New Zealand. So I think this still does need to be addressed, and I think it would be wise if the Minister could fully explain the reasons why that decision was made to go with the extra 2%. But, Mr Chairman, basically this is another means of tightening up the New Zealand financial system. We saw 61 financial institutions go by the wayside in recent years through an appalling period of New Zealand's financial history. The likes of South Canterbury Finance with $1.6 billion going down the tubes that was picked up by the New Zealand taxpayer. That sort of thing cannot be allowed to repeat in the history of New Zealand. This is a mechanism to provide greater controls in this area, more certainty about investment, more certainty about major investment in this country. We are seeking greater investment in New Zealand. This is one means of encouraging more investment in New Zealand by international institutions. Therefore, New Zealand First believes it is, as it always does, New Zealand First always believes if there are improvements to our financial system, improvements to our economy, then it can only be a good thing. New Zealand First supports the bill.
The Honourable Shane Jones.